The United Breweries Management, we have Mr. Stephen Bosch, CFO, and Mr. Punacha, Finance and Investor Relations. I now hand over the call to Stephen for his opening remarks, post which we'll open the floor for Q&A. Over to you, Stephen.
Yeah, thank you, Harrit, and good afternoon, everybody. Thanks for joining our call. As usual, I will kick off with a quick intro. I will cover some snapshot for the year that has gone by, look at the Q4, and also then finish with some guidance for the current year. But for the fiscal 17-18, we're pleased to highlight that we have delivered a strong set of financials with a full year volume growth of 10%, which is ahead of the industry volume growth of 7%. Our net sales increased by some 18%, and PBT, our profit before tax, was higher by 75%. And for the full year, our pan-India market share is in excess of 52%, and we're pleased to see a continuation of the upward trend in both the strong beer segment as well as the mild beer space. In each, our share was up by about 200 basis points. Also, our premium growth rates are in the strong double digits. Ultra as well as Heineken are doing very well. And also our recently launched Kingfisher Storm, which is playing in the affordable premium plus segment, has had a good start in its first year after launch, as we reached and exceeded the 1 million cases mark. So very pleased with that result. Also, we are very happy to share that our largest beer, Kingfisher Strong, has now realized a volume in excess of 100 million cases after growing about 7% last year. And the Kingfisher Strong brand now represents about a third of the industry volume. And looking at the quarter itself, at Q4, we have seen that the volume growth rate has accelerated. Volumes grew 24%, slightly ahead of the industry that grew some 22% in the quarter. And we realized high double-digit volume growth in almost all our key markets. Our net revenue increased by 32%, and our gross margins also improved by about 150 basis points in the quarter versus the comparable quarter in 2017. The company benefited from a very favorable state mix, showing outperformance in markets with relatively high net contribution, despite the increase in input prices of barley, sugar, rice, as well as facing the impact of GST on our input costs. Then looking at some of our regions, or the 4 regions during the quarter, to start with the north, we recorded healthy volume growth in Rajasthan as well as in Delhi. In particular, in Rajasthan, we gained market share quite a bit. In Uttar Pradesh, in UP, our volumes declined. That was in anticipation of the new excise policy that became effective from the 1st of April. In the state of UP, as you may know, we moved from a quasi-monopoly situation to a wholesaler model, where we're now selling to a large number of new players, a large number of new entrants who sell on to the trade. And this policy change has already caused some challenges in Q4, with the trade reducing stock levels in that quarter. Then moving to the south, in that region we saw the industry grow strongly by some 25%, and the company outperformed the market and recorded a 36% growth rate, and resulting in a good market share growth in all these states in the region. And especially good to highlight the healthy growth that we recorded in Andhra as well as in Telangana. And of course, we benefited from the resumption of supplies in Tamil Nadu, where last year, or let's say in the year 16-17, we were partially absent in that state. In the east, the company's volume growth was 21%, round about the same or a little less than what the industry did in that region. We were doing very well in Orissa, where we gained substantial market share. In West Bengal, however, it continues to be a challenge in that state, on top of the route to market change that we saw last year. the state also announced a very steep excise duty increase that has led us to withhold supplies for most of the quarter in order to obtain some further clarity, and the situation got resolved towards the end of March 18, and that has also impacted to some extent our market share in that state. Then finally in the West, the industry bounced back to growth of about 16%, and also our volumes recorded growth of around that same percentage of 16%. In Maharashtra, including Mumbai, our volumes grew by 18%. As a consequence of that, we gained market share in the state. Now, that's it for the regional development. Then if we look at the overall cash flow and balance sheet situation for the company as a whole, on account of better working capital management, the working capital cycle improved by 3 days, from 31 days last year to 28 days in the current year. In terms of financial postings for the quarter, I want to highlight a one-off provision that we took of about 18 crore on account of overdue receivables outstanding with the State Beverage Corporation in Bihar that we took in the quarter. And as you all know, this is related to the prohibition there that we stopped selling in the state of Bihar. Finally, some guidance for the current year. We expect continued growth. We see a high single-digit volume growth for UBL. From a pricing point of view, also we've taken price increases in several key markets, including in Karnataka as well as in Maharashtra in April. And in May, the industry received confirmation from the state of Telangana that a 10% increase in the ex-brewery price will be granted. So these developments should help drive our overall price realization. Then on the portfolio side, we launched a new brand earlier this month. It is the Amstel brand from the Heineken stable. It's a strong beer offering, and we expect it to do very well in the Premium Plus category, where we so far did not have an international brand as part of our portfolio. With this, I end my introduction, and I invite the participants to raise any questions that they may have. So thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for a moment while the question queue assembles. We have our first question from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, thanks and congrats on very good set of numbers. My first question is on UP and Bengal. In both the markets, the route to market got changed. How do you see growth in first half in these two markets, UP and Bengal?
Yes, indeed. In those two markets, we saw change in route to market. So one was into a wholesaler model, and the other was into a model where we're working with a corporation. There's always the first couple of months of turbulence of new parties coming in and of a distribution network that needs to be established. Once that is over, you can come to a normal ordinary course kind of market. In UP, we believe that there is a more healthy situation where you have a wide range of players coming in, so that should boost volume as compared to last year. In West Bengal, it's a little bit more difficult, where still we are impacted by the higher prices. So there was a large excise duty, excise duty increase, that we have been able to moderate, to mitigate somewhat, but still it's now impacting the beer industry still. So this, in addition to the route to market change, we are now seeing that the impact is more related to a higher price level for the consumer. And to give you an example, in West Bengal, our price point, or the MRP, has gone from 110 to 145 rupees for a bottle. So that's really a significant jump, and that has led consumers to move to other categories, for instance, to country liquor.
So the 30% move in Bengal in terms of pricing would have impacted all beer players, right?
Yes, that's indeed across the board. That's not just UB, but it hits the beer industry.
Okay. And, sir, in terms of market share gains, sir, you are gaining market share. When I see Carlsberg and Bira, they are also gaining share. So is it fair to say that SAB is the one which is losing share?
If you look at the landscape, yes, it's fair to say that SAB has come down somewhat over the last period, and that's what I think is a big driver of this. And Carlsberg has also done well, some share gains, but less pronounced perhaps as they have been growing over the, let's say, previous period.
So my last question is on the Premium Plus. I understand your market share in the Premium Plus is much lower than your 52% pan-India market share. So will Amstel launch be an answer to that? Because the gap is quite high. And why has the gap been, and why have we been ignoring the Premium Plus from a international brand? You already had a brand. Plus, why have we been ignoring craft and variety beers, essentially Bira?
Yeah, so that's basically two questions. So one is premium. Now, in premium, we distinguish between two subsets. So one is the super premium, where you have, of course, Heineken and Ultra and Ultra Max, as well as our import portfolio. Then you have, secondly, the Premium Plus, or in other words, also the affordable premium space, trading a little bit higher than the Kingfisher mainstream brand, or the Kingfisher Premium and Kingfisher Strong. Now, we had no presence in the latter segment, so in the affordable premium space, until the launch of Storm. So there we clearly see that we've done well in the first year of launch. On top of that, we now have Amstel, that also clearly is in response to the demand we're seeing in that space. And then separately, of course, for the Heineken and Ultra brands, we see really healthy growth and beyond average or beyond market growth for those two as well. So it's fair to say that we have an opportunity there to further catch up and to get to our fair share of the volume of the market, so move towards our let's say our fair share of the market. And we see that, for instance, in the premium space, our brands are now selling or growing by some 35%, and the industry for the premium space is at 20%. So clearly we are catching up.
Okay, sir. That's all from my side. Thank you.
Thank you. Anyone who has a question at this time may press star and 1. We have our next question from the line of Ashit Desai from MK Global. Please go ahead.
Yeah, hi Stephen, hi Punacha. Congrats on the very good set of numbers and 10% volume growth after a long time. So if I see your comments, you've talked about 18% growth in Maharashtra this quarter. So if you can break up how much is the effect of restocking, and particularly Maharashtra has seen a big decline this year. So, I mean, as we move into FY19, do we see a recovery in this state?
So yes, in Q4, two effects play a role. So one is, of course, that you see quarter 4 versus quarter 4 17, that there was a relatively easy comparative because of the highway ban, also affecting Maharashtra quite a bit. So that is a catching up almost versus the Q4 last year. And there is some stocking up that happened in January because of our absence in Q3. So that those two effects play a role and have led to the high double digit or the 18% growth in the state. Going forward, we do expect that in Maharashtra there is growth on the horizon, that we can also further gain share. So that is what our analysis of the state of Maharashtra.
Okay, so 18% growth, as you say, doesn't have a big benefit of the restocking. It's largely to do with lower comparables last year.
It's the bigger effect, and there's been some upstocking in the first half of January. But clearly, of course, towards the end of the March quarter, there is more volume in the industry because of season picking up.
Okay. Got it. And secondly, you've increased your capex guidance from 200 crores to 300 crores. So just wanted to know from your side, I mean, are we getting more confident on the volume growth recovery going ahead? And secondly, since we are still at lower than 70% capacity utilization, what is the optimal level of capacity utilization that you would target in the next 2-3 years?
Yeah, so your first question is around confidence. Now, we have, since I think the high ban effects have been put behind us, we have been guiding towards 6, 7, 8% market growth. And on top of that, we are confident we can continue to gain some market share. That is for the pan-India situation as a whole. Of course, then if you look at sub-markets, state by state, then you see that in certain markets, actually, the growth has been more pronounced, so higher growth rates than the pan-Indian average. For instance, Telangana, also more recently, Rajasthan or Delhi. So both in the south as well as in the north, we see opportunities to further enhance capacity, which we are now covering in our annual plan. So that is the confidence that we have that definitely that growth, we see that continue as per our guidance. Then guidance for the coming 2-3 years, I think it's fair to say that we want to take it year by year and see how things are panning out. But clearly, as it stands, we see that there is further requirements for capacity expansion, even if on an annualized basis, our percentage utilization rate may be at 70 or 80%. Of course, it's the peak quarter of Q1 that is guiding for us. That's there we don't want to miss out when it comes to capacity utilization or covering demand in Q1.
Got it. And lastly, you talked about some one-off expense of 18 crores. Was this in Q4? Which quarter is it?
Yeah, that's for the Q4. So that's a provision we took when it comes to the receivables, that's the outstanding positions that we have with the State Beverage Corporation of Bihar.
Okay, so this 18 crores is in Q4 of this year?
Or of the year 17-18, so the quarter had...
Yeah. Because if I see your overhead expenses in March quarter, these are higher than your first quarter also, which is the peak quarter. So besides these 18 crores, any other one-off, or if you can give us the increase in ad spends for the year? I mean, what's driving this significant increase in overhead spends?
Yeah, one point indeed is the advertising and the ATL, BTL expense. As I guided earlier in one of the earlier calls, is that it's a little bit skewed towards year end. So that is a big one effect. And also you see, of course, that when you have high growth, also there is some upward pressure on items like PC costs and other operating costs. Just to get to the service.
Ashit, is your question for quarter on quarter?
Q4 was comparing Q4 versus Q1. Q4 is a lean quarter, but despite that, your overhead spends, which is employee and other expenses, are higher than the Q1 period.
Where did you get your Q1 period from?
Q1 of FY18.
Q1 of FY18?
Yeah.
You have the number with you?
Yeah.
So, employee expenses will be higher because our increment cycle is effective 1st July. So, it will be higher.
Okay, it's never happened in the previous years, which is why I asked that.
No, you're talking about employee expenses or you're talking about other expenses?
I think I'll take it later.
If you ask me specifically, I have details.
Yeah, I was looking at both employee and other expenses together.
You're saying why Q4 is higher than Q1?
Yeah, it's
because
570 crores versus 560 crores.
Yeah, see, if you take Q1 of FY17-18, in Q1 you will not have your increments in place.
Right.
Increment on 1st July. And in addition to that, if there is a change in your interest rates, your gratuity provision also goes up with your increase in your salary income. So that provision also will kick in. So technically speaking, you will have a higher employee expenses in Q4 vis-a-vis Q1. Regarding other expenses, yes, in addition to what Stephen mentioned with respect to doubtful debt, we have higher amounts with respect to bottling fee, which is a statutory due which is paid on cross-border movement of missing sourcing mix and freight. So these are the other elements if you compare the other expenses.
Okay, I just wanted to know if there's a significant jump in ad spends this quarter versus the previous quarters.
No, ad spends is in the similar trend. So the changes are only with respect to provisioning, with respect to cross-border movement and bottling fee, and to some extent freight.
Oh, can you share what's the full year ad spend growth?
Ad spend growth is in line with the growth in the previous year. As you know, we don't give that detail, but it is not substantially different from what it was in the past years.
Okay, I'll come back in the queue. Thanks, and all the best.
Thank you. A reminder to all the participants, you may press star and 1 for asking a question. We have our next question from the line of Krishnan Sambamurthy from Motilal Oswal. Please go ahead.
Yeah, hi. Congrats on a good set of numbers and congrats on the performance of Kingfisher Storm as well. Last year in the summer season, you also launched 5 brands from the Heineken stable. This include Dulce Quiet, Desperados, Edelweiss, and so on. Can you give us an update on their performance as well, maybe in terms of millions of cases?
Yeah, this is indeed a brand portfolio of 5 brands, full 5 brands, that have been rolled out in the higher end of the market, right? So these are retailing at totally different price levels than your Kingfisher Storm or Kingfisher Strong. So it's something that we're building carefully to ensure that we have the right presence. And in all fairness, this is not in millions of cases. This is more in this is a smaller segment altogether, where we will continue to grow, continue to invest, but don't count in millions.
Okay. Or let me rephrase that question. I believe UB's market share in the imported beer market is less than 15%. What would be the share after these brands have been launched, and what will be a target?
Okay, that I don't have these shares for the particular segment with me here. It's fair to say that there is we didn't import any other brands beyond these. So all the brands that we're doing here in India are domestically brewed. So it's purely an incremental volume that we see coming from foreign markets.
Okay. Thanks a lot.
Yeah.
Thank you. Another reminder to all the participants, you may press star and 1 for asking a question. We have the next question from the line of Ravina Reddy from Naredi Investments. Please go ahead.
Sir, how much growth we are expecting in top line this year?
So the volume growth that we have guided is high single digit growth. So
high single digit.
Yeah.
And what is expecting Amstel beer in India? At what price you will launch?
Could you repeat that question?
This Amstel beer, at what price we are launching in India?
Well, it is in the affordable premium segment, and that is at a price index of some 120%. So it's around about 135 rupees per bottle, MRP.
Okay. Thank you.
Thank you. Anyone who has a question at this time may press star and 1. Participants, if you wish to ask a question, you may press star and 1 at this time. We have the next question from the line of Mr. Harit Kapoor. Please go ahead.
So I'm just going to just had a couple of questions on the balance sheet side. So, the capex that you spoke about, would that be, in terms of greenfield, or is it, adding to additional capacities in states?
This is ordinary course CapEx in our existing facilities. So we're upgrading and extending some of our facilities, but we're not, when we call out that percentage growth, we don't refer to any greenfield.
Absolutely. Okay. And on the working capital side, we have continuously improved the working capital levels. Now we're just down to about 28 odd days. Given that, the growth rates are probably going to be a little better than what it has been in the past, are we expecting, the little bit of increase in investment on working capital side, or do we believe we can, sustain it at these levels of days that we are currently at in FY18?
Harit, working capital which is purely under our control, we will surely try to look at even better levels of operating, meaning ordering, stocking, but payments, all these things which are under our control, we will try our best to make the best effort towards having better efficiencies. However, one thing which is really not in our control is the debtor collection with respect to dispatches to government corporations. And 65% of our sale is to government corporations. And we have seen that in the past year and a half, large corporations delaying far beyond the payment terms. So there we have little choice or little control over working capital.
Okay. I'll come back for more. That's it. Thanks.
Thank you. We have the next question from the line of Bharat C. from ICICI Direct. Please go ahead.
Yeah, congrats on a good set of numbers. Sir, just wanted to know how do we see the pricing scenario and in how many states have we got the price hikes in FY18 and probably would we still be seeing price hikes coming in FY19?
Right. So I think there is types of markets, right? Markets where you can pursue price increases on an annual basis at least, and other set of markets where there is more restrictive pricing.
Yeah.
One example I gave of Telangana is a market. After many years, there's now the industry was granted a price increase. Other states like Karnataka, like Maharashtra, like some of the other big states that we do business in, we can pursue annual increases. For instance, in Goa, we have gone for a price increase, and also in states like in Delhi, we had in Q4 a price increase. So that's ongoing. And in a state like West Bengal, we deliberately, we have so far not gone for a price increase because of the high excise duties that we have seen in Q4. So where we can grow prices, and where we cannot, we try to have a dialogue with the excise officials or excise or the states to grant us an increase from time to time.
Okay. And also, sir, just a question on the input cost scenario. How is it currently and how do you see it going forward from here on?
I didn't get a question.
The input cost scenario currently and our view going forward on the input costs.
Input costs?
Yeah.
Yeah, the input costs, as a percentage of our net sales, should by and large remain. When we say our gross margins should be maintained at the current sales mix.
So just to add to that, if you see the 2-3 we have barley or malted barley, sugar, and rice. Malted barley, we're yet to see a softening, so we have over the last years resorted to importing. That may still be required to have the proper and to continue the input prices or to avoid increases there. Sugar is a bit of a better scenario where we have more availability and we expect sugar to soften a bit. Rice, not much, I think, softening so far expected. And bottle is an important one as well. The bottle costs, we may see some inflation coming through into our new bottle prices. And of course, a big input there is the new bottle infusion to make sure that we minimize new bottle infusion and maximize the return rate. And that will also impact the bottle cost.
Okay, sir. Thank you. That's all from my side.
Thank you. We have the next question from the line of Rajasa K from Franklin Templeton. Please go ahead.
Yeah, hi. Just want to follow up on the pricing question asked previously. So in fiscal 18, is it possible to share what was the weighted average price increase you received over the year?
Yeah, that we don't single out like that. So we have multiple effects playing a role, right? So you have the stick mix, product mix, brand mix, source mix, and then you have like-for-like pricing. So it's a mix of things, and there is a lot of markets there where we take relatively modest price increases, 5 or 10 rupees per bottle on the MRP. So that is something that is across the board can impact the realization levels.
Right. So, I mean, something similar to the spirits industry, which received price increases from almost 15 states, I believe. Do you think even in your case, this year was exceptionally good in terms of pricing as well as state mix as a combination?
No, I mean, spirits have received price increases from Telangana and AP, which we have not. If you see, that is very different from what we have got, because that's a large market for spirits and beer. So for financial year 17-18, with respect to price increases, you can't compare the beer industry with the spirit industry. With respect to sourcing mix, things will change. So, I mean, it depends on, for example, in a year where growth rates are up, we will have to source from breweries which are far away and across states. So it would change the realization to some extent.
Right, understand. So just then a broad indication on how to look at margins. So FY18, you've ended at around 16.5% EBITDA margin for the year. Now, hypothetically, if your expectation of volume growth were to come through for FY19, and given the visibility you have on pricing and raw materials and in general inflation, do you think you can build on these margins in FY19?
We will not give sort of guidance on our margins. The only thing that I wanted to highlight is that our margin has proven to be very dependent on the mix effects. So you have low realization and high realization markets. If there is really good growth in some of those low realization markets, really good for our share, good for volume growth, but less positive for our margin. So it's such a big driver that I don't want to give any guidance on that.
All right, thanks.
Thank you. We have the next question from the line of Ashit Desai from MK Global. Please go ahead.
Yeah, hi. Just a few follow-ups. In UP, we talked about the change in distribution model. Post these multiple distributors have come up, has there been a benefit in terms of lower trade incentives and better realizations in that market?
It's a bit too early to tell, but what I can tell you from a finance point of view is that we are really mindful that we, from day one, want to adhere strictly to terms and conditions, that we don't overshoot, or that we try to maintain some discipline in the trade. So it's important to keep that going and avoid that, and so to make sure that we, as a supplier, can take some or capture some value, as opposed to the previous situation where there was a monopolist.
Okay. And what is the price hike we've taken in Maharashtra and Karnataka?
Modest increases. It's more rounding or small increases on our KF and KFS brands.
Okay. Lastly, what would be our market share in Tamil Nadu now? And would there be a catch-up in the first half next year also?
So we have now seen that the Tamil Nadu base effect is now behind us, right? So we had this zero, that we were out of the market for a large part of the year 16-17. we're now back to, let's say, a more normalized market share, and it's. I don't expect from there on a lot of firework or a lot of big moves.
Got it. Thanks.
Thank you. Another reminder to all the participants, you may press star and 1 for asking a question. We have our next question from the line of Abneesh Roy from Edelweiss. Please go ahead.
So in the past, we have seen the glass prices, especially and packaging, have an indirect correlation with crude oil. What's your expectation there? With a lag, can glass prices and packaging move up sharply?
Yeah, so as I mentioned, we do see some upward pressure on glass, on new bottle costs on glass coming in. So that is something we monitor, but clearly is something that could have an influence. Yeah.
Sir, your expectation that FY19 should be around high single-digit volume growth. That seems to be one of the most bullish statements at the start of the year your company has made. Is it because first half there is a favorable base because of highway ban in FY18 and first half impact? Or is it because actually underlying trends or because market share gains are happening? Which of these three is the key reason?
You're hitting the nail on the head. It's indeed, those effects are all playing a role. It is indeed still especially for Q1. And we had in the first part of Q1 last year quite a bit of turbulence and challenges that we saw as a result of the highway ban. Also, there is, going forward, in absence of big regulatory issues, we are more confident than before that there is a 6, 7, 8% market growth opportunity. And the trend we have seen recently is that we've been able to gain some share steadily. And that steady continuation of share gains should help us also to gain or to grow by a high single-digit percentage.
The last question is on pricing. So Telangana, you've got a 10% price hike. So what percentage of your volumes comes from Telangana? And because GST has led to increase in terms of the raw material cost, do you expect more states to give price hike in FY19?
On Telangana, I can assure you it's a big market. We don't give the, let's say, percentage salience or weight of that market, but it's a large market for us. It's one of the larger markets we have in the country, and I have no further comments on price points. So we do, where we can, want to pursue price increases. So some we have already done in Karnataka, Maharashtra, and some we're dependent on these states. So on the state authorities to see if we can get it approved, but I've got no further guidance on it.
So one more question on route to market. In the last 1 year, we have seen quite a few states do change in terms of route to market. Why suddenly states have woken up to that? Is it because in GST they have very limited room for impact on other sectors in terms of taxation? And so if this could snowball into more states going into route to market change, what's your take on this?
There's always been some changes in route to market. I'm not entirely sure whether it's related to GST. So we've seen that, for instance, in Uttar Pradesh, we're still working with private parties as our distribution partners. Only in West Bengal we have seen a move to a corporation, and where earlier there were rumors that in Haryana we'd also move to a corporation, that hasn't actually happened, and we're still in the same situation as we were previously.
No, but is corporation good for you or say market leader in general? Is it good for you? Do you see that as positive, or do you have uncertainty or any concern on this?
So we, as Punacha said, we've been working successfully in corporation markets over the last many years, especially in the south. That is where we see these markets. As I've mentioned before in earlier calls, that if you are the market leader and a corporation should normally give you a level playing field, then it's not bad for us. On the other hand, of course, the corporation market also has its own challenges. It's not the most, let's say, customer-friendly model. And also, as Punacha mentioned, you have quite a big working capital impact where you cannot drive your own trade terms and you are bound to certain receivable days. Punacha, anything to add on this? No. So this is what we see. So it's not necessarily bad for us, but also it's negatives.
Okay, sir. That's all from my side. Thank you.
Thank you. Participants, if you have a question at this time, you may press star and 1. We have the next question from the line of Amar Kalkunzekar from HDFC. Please go ahead.
Yeah, hi, good afternoon, gentlemen. I have just 2 housekeeping questions. One is, what is the amount of borrowings for the year as at the end of the year?
As of 31st March 2018?
Yes, please.
308 crores.
Okay. And secondly, the other income is lower YOY for the full year. Is that because of this some mega project benefits not coming or anything of that sort?
Yeah. The other income as of 31st March 2017 had 31 crores of a government grant. This is a one-time, which is not there.
Got it. Thank you very much, sir.
Thank you. We have the next question from the line of Harit Kapoor. Please go ahead.
Hi. So just one question was on the competitive intensity in the marketplace. Now, I remember a year or two back, we had seen intensifying intensity from the the number 3 player as well as other players. So just wanted your comments on FY18. How have you seen that, and are you seeing a more rational environment on the competitive intensity side from the key players?
Yeah, difficult to see a meaningful trend change in terms of behavior. I think it is and remains a competitive market where there's a lot of markets where we are, especially with the big 3 players all coming together and have our own set of brands to compete. And we see that we've been reasonably successful over the last year, and we keep a close eye on what other parties are doing, and also look at the emerging players right in the craft and variety space to see how that pans out and what we can do there.
Perfect. As there are no more questions, we'll close the call here. I'd like to thank on behalf of IDFC all the participants in the call as well as the management for taking out time for this call. Now hand over to Stephen for his closing remarks.
Yeah, thank you, Harit, and thanks everybody for participating, and thanks for the interaction and the questions raised. We're always available offline, so please do reach out, and I look forward to interacting with you in one of our next calls. Thank you.
Thank you. On behalf of IDFC Securities, that concludes this conference. Thank you for joining us.